Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is titled The Annual Report of the Financial Stability Oversight Council. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I'll note at the outset the hearing has a hard stop at 1 p.m. Thank you, Secretary Yellen, for being here. I'll now recognize myself for 4 minutes to give an opening statement. Thank you, Secretary Yellen, for being here today and your capacity as chair of the Financial Stability Oversight Council. FSOC's purpose is straightforward: to identify risks that could impact our financial stability, promote market discipline by eliminating expectations of bailouts, and respond to emerging threats. FSOC's name pretty much sums up its mission. And yet, under the current leadership, we've seen FSOC expand its regulatory reach to fit the administration's political priorities. That's unfortunate. And unfortunately, FSOC appears to be a part of the same troubling trend as Biden's other financial regulators. When you're distracted by shiny partisan objects, you take the eye off the ball. For example, aside from a stale mention of interest rate risks in 2022, the annual FSOC report of that year, the FSOC did nothing to identify the emerging instability that set off the March 2023 banking sector turbulence. And indicators produced by FSOC's research arm, the Office of Financial Research, showed no signs of emerging risks, even as the risk was indeed emerging. Secretary Yellen, we remember the panic Americans experienced in March. I commend you for your willingness to engage in stabilizing the markets. I think that with your credibility, lent a lot of effort to the administration. And at that time, we worked together to quell concerns and provide a level-headed response in an uncertain time. The goal was to do no harm and regain stability without injecting politics, and I think we achieved that. A goal that President Biden clearly did not share when he took advantage of the situation to blame Republicans for what was a widely bipartisan regulatory reform law enacted a few years ago. In real time, many members of this committee stood behind regulators' emerging actions with the expectation that we and the public would receive a full accounting of the decisions made that week. Now, nearly a year later, we do not still know the full story as FSOC and other administration officials have been less than transparent. To be clear, this does nothing to calm the nerves of an already skittish consumer. And with issues still plaguing some regional banks, it's irresponsible for this administration and fellow regulators to continue to stonewall. While Republicans have worked to get the answers the American people deserve, FSOC has been busy making changes to enable it to serve as a roving regulator, something architects of the Dodd-Frank Act vigorously promised FSOC would not be. This includes relaxing the criteria used to designate non-bank financial companies as systemically important and putting them under Federal Reserve regulation. This proposal is based on the premise that our financial system would be best served with more oversight and control by the Federal Reserve, even beyond banks. It's important to note that the gross incompetence of the Federal Reserve and FDIC supervision is what led to the bank failures in March. However, prudential regulation is grounded in mitigating the specific risk that bank activity poses. These regulations are not necessarily appropriate for institutions that may engage in different activities and therefore pose different risks. Given the significant consequences associated with this systemic risk designation, Congress did not intend for this designation to be politicized nor weaponized. This move, taken with the apparent failure to identify and respond to emerging risks, calls into question the effectiveness of the Financial Stability Oversight Council. Secretary Yellen, I would encourage you and your fellow regulators to get back to the work you've been tasked with. We've already experienced what happens when you take the eye off the ball and get engaged in politics. The American people should not have to suffer through that again. I yield back. I now recognize the ranking member, Ms. Waters, for 4 minutes.
Thank you, Mr. Chairman. Treasury Secretary Yellen and President Biden's economic team have been hard at work to turn the tide on the disastrous economy that the twice impeached, 4 times criminally indicted former president left us. The numbers show their hard work is paying off. In 2023, the unemployment rate remained below 4%, and the economy created a whooping 2.7 million new jobs, more than any year of the Trump administration. Inflation has fallen to the pre-pandemic level of 2% over the last 6 months. 16 million small businesses have been created, and twice as many Black households now own a business. Workers' wages and wealth are higher now than before the pandemic began, with income up nearly 4% last year after adjusting for inflation. To top it off, consumers' confidence is returning to our nation's economy, and they are shopping and traveling again. There is currently more work to do to address the housing affordability crisis, but the Biden administration has masterfully guided the United States to the fastest economic rebound from the pandemic of any wealthy country in the world. Of course, this progress would not be possible if it were not for Secretary Yellen's strong leadership and that of President Biden's banking regulators, who decisively prevented harm to our financial system after the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. Make no mistake, the seeds of that banking crisis were planted by Trump and his bank regulators' deregulation of regional banks. Less than a year later, it's a shame that Republicans have teamed up with Wall Street to spread misinformation and to try and block efforts to strengthen capital at our nation's biggest banks. Wall Street is peddling lies about what's needed. The needed capital reforms will do, going as far as taking out expensive TV and social media ads and even setting up a website to purportedly educate the public, except it is filled with misleading claims. What they don't want you to know is that the only people who benefit from lower capital requirements are the wealthy bank executives. Less capital means consumers are left more vulnerable, especially in a downturn, while bank execs take home bigger bonuses each year. Lower capital requirements also mean that taxpayers are more likely to be called on to bail these banks out when they run into trouble. Let's be clear. Research overwhelmingly shows that well-capitalized banks lend more than other banks in good times and in bad. I'm sure the Secretary will set the record straight about how these capital reforms will ensure first-time home buyers, small business owners, and communities of color looking to build wealth can better access credit and prevent future bank crises. Finally, I want to applaud the Financial Stability Oversight Council for updating its designation procedures to ensure the Council can use all of its tools to protect our economy. I also applaud the Council for continuing the work Committee Democrats started by guarding us against risk from artificial intelligence, cryptocurrencies, and climate change. I'm so proud to see Secretary Yellen here today. Thank you for all that you've done in your leadership. And I look forward to today's hearing, and I yield back the balance of my time.
We'll now recognize the chair of the Financial Institutions and Monetary Policy Subcommittee, Mr. Barr, for 1 minute.
Secretary Yellen, the 3 statutory purposes of the Financial Stability Oversight Council and Dodd-Frank are to identify stability risks, promote market discipline by eliminating bailout expectations, and respond to emerging stability threats. Last March, FSOC did not identify a systemic risk as it emerged, did not promote market discipline as 100% of large uninsured deposits were bailed out, and did nothing to respond to the emerging stability threats. Nothing would have been different if FSOC had never been created. FSOC has not fulfilled its statutory purposes. Instead, it is an unaccountable, roving regulator ensnaring private firms into the regulatory net using new designation processes that remove analytical discipline. We are left with an FSOC used to pressure nominally independent financial regulators into whatever policy objectives the Biden administration wants to push into the regulatory framework without legislative authority. The current FSOC is poised to operate as a partisan body and a rogue regulator, which is not what is statutorily intended in Dodd-Frank. Or maybe it was intended to act that way, and we don't like it. And we look forward to your testimony today. I yield back.
Gentleman yields back. We'll now go to the chair of the Financial Institutions Monetary Policy Subcommittee, the ranking member, Mr. Foster, for 1 minute.
Thank you, Chair McHenry. Secretary Yellen, thank you for joining us today and for your leadership of the Treasury Department. Since the Dodd-Frank Act created FSOC in 2010, it's been a vital forum for U.S. financial regulators to share information regarding systemic risks to our economy. FSOC's comprehensive view of the financial system is critical because systemic risks rarely develop in ways that fall entirely within the jurisdiction of a single agency. This year also marks the first time that artificial intelligence has been listed as a vulnerability in FSOC's annual report, and I'm happy to have seen the steps that financial regulators have started to take to address AI-related risks since President Biden's executive order on AI was issued last fall. While AI presents many opportunities to make our financial system stronger, deepfake impersonations have the potential to supercharge financial fraud and cybersecurity risk by making it harder to identify the real identity of the person on the other end of a call, a video, or an internet connection. The response to emerging issues like these should not take place in a silo, and I'm happy to see FSOC recognize the importance of holistically addressing these and other emerging risks. Thank you, and I yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Janet Yellen, Secretary of the Department of Treasury. I'll not go into your full bio, but suffice it to say she's held every significant economic post in our government. We welcome your testimony today, and thank you for being here. You'll be recognized for 5 minutes for oral presentation of your testimony. Without objection, your written testimony will be made a part of the record. You're now recognized for 5 minutes. Thank you.
Thank you. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for inviting me to testify. Over the past 3 years, the Biden administration has driven an historic recovery. GDP growth is strong and inflation has declined significantly. We've also achieved a healthy labor market. The prime age labor force participation rate is up by over 2 percentage points from January 2021. The unemployment rate remains below 4%, continuing the longest streak in 50 years. Real wages have increased. Household median wealth has too, by 37% between 2019 and 2022. That's the largest 3-year increase on record. Families are now putting their additional income and accumulated savings back into the economy. Our continued economic strength depends on a solid and resilient U.S. financial system. Throughout 2023, the Financial Stability Oversight Council monitored a wide range of risks, including risks stemming from commercial and residential real estate sectors and from global geopolitical conflicts and technological developments. When 2 regional banks failed last March, we acted quickly to prevent contagion to banks with similar vulnerabilities and to maintain confidence in the banking system. The Council also increased transparency this year, issuing an analytic framework that for the first time provides the public with in-depth information on how it monitors, assesses, and responds to potential financial risks. Let me now highlight 5 areas of ongoing work that are further detailed in the Council's 2023 annual report. First, the Council is focused on risks from the banking sector and from non-bank financial institutions. It supports member agencies' plans to review whether capital measures appropriately reflect a banking institution's ability to absorb losses, improve resolvability at large, complex, or interconnected banks, and address vulnerabilities from uninsured deposit levels and depositor composition. Non-bank financial institutions are an important source of capital in financial markets, but also pose potential risks to the financial system, including risks related to liquidity mismatch and leverage. Securities and Exchange Commission initiatives focused on hedge funds, money market funds, and other investment funds are an important step forward here. Second, the Council is focused on member agencies enhancing assessment efforts and increasing coordination around climate-related financial stability risks from increasingly severe and frequent climate-related events. Financial regulators should also continue to promote disclosures that allow investors and financial institutions to consider these risks in their investment and lending decisions. Third, a key focus has been bolstering protections against cybersecurity risks. The Council promotes sharing timely and actionable cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiencies, and potential risks like cyber and model risk. Financial institutions, regulators, and market participants should continue deepening their expertise and monitoring capacity in this area. Fifth, the Council is focused on digital assets and related risks, such as from runs on crypto asset platforms and stablecoins, potential vulnerabilities from crypto asset price volatility, and the proliferation of platforms acting outside of or out of compliance with applicable laws and regulations. Applicable rules and regulations should be enforced, and Congress should pass legislation to provide for the regulation of stablecoins and of the spot market for crypto assets that are not securities. We look forward to continuing to engage with Congress on this. With this overview, I look forward to taking your questions on these and other areas.
Thank you, Secretary Yellen. I'll recognize myself for 5 minutes. And so let's begin with your last point on the regulation of the spot market for digital assets. This committee has produced 2 bipartisan bills, one on stablecoins, one on market structure to regulate the spot market of digital assets and provide this clarity between the CFTC and the SEC. So you testify that FSOC's view is that we need federal law and law changes on the spot market. Can you tell us why? Can you describe why? That's FSOC's belief.
Well, there are many areas with respect to digital assets where we do have clear regulatory authority, but we've identified some gaps where for consumer investor protection and to address financial stability risk, it would be very useful for Congress to take action to fill those gaps. And the CFTC, for example, doesn't have supervisory or regulatory authority with respect to spot markets in commodities like Bitcoin. So that's a regulatory gap. Furthermore, stable coins pose risks to the financial system that both FSOC and the President's Working Group on Financial Markets have identified as potentially becoming significant over time, and we would very much welcome an effort by Congress to create a regulatory framework that would be appropriate to address those risks.
So stable coins are now being regulated by the states. New York has a very resilient regime. Are you suggesting something like the New York regime would be applicable to fix this problem?
Well, FSOC believes that it's critical for there to be a federal regulatory floor that would apply to all states, and that a federal regulator should have the ability to decide if a stablecoin issuer should be barred from issuing such an asset. Okay. Also, we believe that because wallets are a critical part of the stablecoin ecosystem, and we've seen many instances in which there have been significant losses, that it's critical to enact regulatory protections for holders of wallets.
So back to the spot market, though. As in your report, you state clearly that we need to change law for us to have proper regulation of the digital asset spot market. Is that correct?
Yes, that's a recommendation.
Okay, so broader. Let's go to the broader set, not the emerging issues. But in November, FSOC issued its final guidance on non-bank designation. Are there firms that FSOC has identified that are being analyzed right now for designation?
Well, I don't think it's appropriate for me to talk about individual firms. We've certainly not reached a stage at which the council has taken any action or received recommendations with respect to designation. We did put out, as you know, you mentioned, revised guidance pertaining to non-bank designations, and we published an analytic framework. But we wanted to make sure that our entire toolkit that Congress gave to FSOC is usable. There are many tools in that toolkit, and the analytic framework recognizes that designation is only one of those tools. It's not, in any sense, the preferred tool. It really depends on the specifics of the financial stability risk.
What many of us have highlighted is the fact that that is such an opaque process that it leads to greater instability, greater uncertainty in the marketplace. But let me finish with this, the overall economy. As Fed Chair Powell was interviewed this past weekend on 60 Minutes, he says that the American people, they have a right to be unhappy. The cost of food is dramatically up under your tenure as Treasury Secretary in this administration. What do you say to the American people that are unhappy with paying more for the basics of life?
Households have been struggling through the pandemic with many burdens, including a higher cost of food and some increase in gas prices. We've had a couple of years of high inflation, and it's a top priority of this administration to bring inflation down and to use the tools we have to reduce the burdens on hardworking households. We have certainly used it with respect to health care costs, limiting insurance premiums for health care, the co-pays for insulin.
My time is